And water. All right, I guess we can get started. Thank you all for being here. Of course, it is a true honor today to have Chair Jay Powell and former Chair and Nobel laureate Ben Bernanke with us today. Thank you very much for being here. I've very much been looking forward to this conversation. I'm sure our audience has too, so let's just get to it. This conference, as everyone knows, is dedicated to the memory of Thomas Laubach. And earlier this morning, we heard some personal reflections on working with Thomas from Secretary Janet Yellen, also former chair of the Fed, and from President John Williams. And both of you worked closely with Thomas as well. So I'd like to give you both an opportunity to share your own thoughts about Thomas's contributions as an economist, as a central banker, as a colleague. Ben, maybe we could start with you.
Sure, and it's great to be here. I was Thomas's thesis advisor, and he worked with me on a book on inflation targeting when he was still a graduate student. And that was a long time ago, and he was not yet in his exalted position at the Fed when I was doing Jay's job. So I don't have any short little anecdotes to give, but I do want to say that I think there are sort of two kinds of accomplishments a person can have. They can have curriculum vitae accomplishments, and they can have what I call eulogy accomplishments. Curriculum vitae accomplishments are things like published papers and promotions and awards and mission. Eulogy accomplishments are the things your family remembers. You know, your kindness, your support, helping other people, and so on. Thomas was one of the few people who scored high on both dimensions. On the CV side, beginning to work with me, he had a tremendous input into the Federal Reserve's framework, targeting, working on the more recent Fed framework. He did work, I'm sure John Williams talked about his work with the metrics of deficits on interest rates, again, and their contribution. So a person who made a lot of intellectual contributions to the person, he was just friendly, helpful person, and he was just a joy to work with. And you know, I'm glad to be here to, you know, say this about him.
Thank you, Jay.
Thank you, Trevor. So first of all, let me say this conference is a very big tribute to Thomas, and really delighted and honored to be part of it. And let me, my thanks to those who made all this happen. Thomas, when I joined the board as a governor in May 2012, almost 11 years ago. And in preparing to join the board, and then in the early years at the board, I was very focused on developing, you know, a deeper background in macroeconomics and monetary policy. Many people here at the board supported me in that process, too many to name here, but I will say Thomas really stood out. And it was during the process of reading, you know, the literature and discussing it that I really started to get to know his ability to obviously loved talking about economics, and his great enthusiasm and willingness to engage with me, a new governor, was immediately evident. He was very gracious to me, and we had a lot of informative discussions. So rather than being his teacher, I was really his student in those early years. As you know, by the time, as you noted, by the time I became chair in 2018, Thomas was the Division of Monetary Affairs, and in that role, he was a trusted advisor to me and to the FOMC. His leadership was, he conducted our first ever public monetary policy review. He played a major role in organizing that, identifying key topics, and organizing the staff all through the Federal Reserve System. He also played an absolutely essential role during the critical period of the pandemic, enabling our tools to stable financial, protect the economy from more dire consequences. And through it all, he did come through as for his dedicated mastery of monetary economics, but also being a terrific, great colleague and a great person.
I think there's a lot of agreement for the sentiments that both of you have expressed. Appreciate that. Before we have questions on some current issues, I did want to ask you both about any formative experiences that you may have had that have shaped your views, particularly about your thinking about monetary policy. Paul Volcker, in his oral history interview, tells the story of his mother, who was adamant that he received the same dollar value monthly allowance when he was in college that his older sisters did 10 years prior. I'm happy about that because obviously eroded the purchasing power of that allowance. So as far as it goes, that was the beginning of his personal commitment to price stability. So Jay, do you have any such stories to tell?
Quite that on point. So graduated from college in 1905 during what we now call the Great Inflation, and same college year as Ben. And I started working as a lawyer in the financial sector in the late 1970s. I recall from that time what high inflation was essentially a part of the landscape, just something that we all had to accept the cost of getting rid of it. So you just were getting used to it. Of course, ultimately, the Fed did step up and restore price stability. One lesson from that era is really the foundation of a strong economy, and that the economy doesn't work for everyone without price stability. Another is that high inflation is when we have inflation, is responsibility and the obligation of the central bank for stability. Inflation isn't as high as it was, nonetheless far above our 2% objective, and people are currently experiencing high inflation for the first time in their lives. It's not a headline to say that they really don't like it. So we are very aware that high inflation imposes significant hardship as it appeals to our margin and living paycheck to paycheck and need to use all of their incoming income to pay for food, housing, and transportation and other to grow 2%. We think failure to would not only the social costs of getting back to price stability, causing even greater harm to families and businesses. We aim to avoid that by remaining steadfast in pursuit of our goals.
Thank you. Dan.
I had those family shirt at MIT in particular, but I'm going to tell you about something that happened at 6 years old. I used to visit my grandparents in Charlotte, North Carolina during the summer, and I would sit on the front porch of their house and listen to my grandmother tell stories about her life. And she told about how she raised her family in Connecticut in the 1930s during the Great Depression. And it was a town that was specializing in shoe manufacture, and during the Depression, a lot of the factories were shut down. And she told me that it was a very hard time. A lot of the kids went to school, battered shoes, or maybe no shoes at all. And I said, Grandma, why would they do that? And she said, well, because their fathers lost their jobs. Why did they lose their jobs? Because the shoe factory shut down. Now, I was only 6 years old, but I could see the problem with that argument. I said, well, why didn't they just open the shoe factories and make shoes for the children? And she said, it doesn't work that way. But I think it really was a puzzle to me that the same productive capacity in 1933 that you had in 1928, and 1928 people were dancing to Charleston, and in 1933 they were in bread lines. And it really impressed on me, that economics can make really big difference in people's lives. And monetary policy is like that. I mean, it's, as Jay, of course, and all of you well know, that the decisions made in this building have a very broad and real effect on people's lives. And for that reason, besides its intellectual fascination, it's worth studying and understanding.
Yeah. Thank you. That's certainly a key motivation for many people in this room to be working. Okay, some topics of more interest. And I'll start with the nexus between the financial system and you. Your 10 years as chair have faced very significant financial crises in front of the global financial crisis. Those episodes were very, very vivid example between the macroeconomy and the financial system, as well as, I think, a good illustration of the role of central banks in such episodes. But Ben, your research, importantly, and the research that you have inspired, has really demonstrated that understanding the connections between the financial sector, credit markets, and banks and the real economy is critical for even understanding traditional business cycles. So with that as background, we have just experienced a period of stress in certain parts of the banking system here in the United States. So I want to get your take on those developments, how you think they match up compared to some previous episodes, and what they might mean for the economy.
Well, in some dimension, the recent crisis has followed the standard sequence. I don't know anything about Silicon Valley Bank other than what I read in the paper, so please don't misinterpret this, but it was a classic situation where they had assets that were subject to risk. In particular, as interest rates rose, the value of their long-term assets fell and their capital fell. They had hoped to hedge that by their deposit franchise, where as interest rates rose and interest rates moved more slowly on deposits, that would partially compensate, but they were dealing with customers who were very social media savvy, and that didn't really work. So after the decline in capital, you had the second stage, which is runs, people taking out their money, which ultimately led to the collapse of the bank, despite, I may add, the good efforts of the Fed and the FDIC to provide liquidity and provide support for depositors. The third stage of a banking crisis is contagion, and people looked at other banks and said, oh, they look sort of vaguely like Silicon Valley Bank. They got the same number of letters in their name and all kinds of things like that, and that caused people to begin to remove, deposits elsewhere. And finally, the reason this is important is that it ultimately affects credit conditions, and the Federal Reserve is, of course, looking at the effects of bank problems and other financial issues on the extension of credit and therefore on the real economy. So, in that respect, I think it's very similar to other crises. I think it's different from the global financial crisis in many ways, including its scale and scope, of course, but I would mention a couple of things, a couple of important differences. One is that the impaired asset in this case was US Treasuries, which are very different assets in kind from subprime mortgages, in that US Treasuries can always be valued accurately, and so there's not the uncertainty that was associated with subprime mortgages. And secondly, as the economy declines, US Treasuries actually become more valuable rather than less valuable, and so there's kind of a counter-cyclical effect. So that's one very important difference, I think. And then the other worth mentioning, but very important, is that relative to, say, the GFC or the Great Depression, overall, borrowers are in much better shape, than they were in these previous episodes. And that makes a big difference, both in terms of the stability of the banks and also in terms of the impact on consumer spending and the economy in general.
Well, I guess a major reason that situation didn't get worse, and I think the contagion was very much contained, were the forceful actions, Jay, that you and the Federal Reserve took through the use of your liquidity tools, including the creation of the Bank Term Funding Program. However, in deploying these liquidity tools, that is, against this backdrop where the preeminent monetary policy concern is high inflation. And that's, of course, a little different from some of the earlier episodes, and has raised new discussions about the so-called separation principle, right? And so I wanted to ask you how you think about the use of financial stability tools, additional monetary policy tools, and how they fit together.
It's an interesting question. Mark, by that the overall, the banks and the banking system are strong, resilient, and well-positioned to deal with the challenges they may face now or in the future. So as you pointed out, we do have separate tools monetary policy to achieve macroeconomic objectives, tools to address financial issues. But I see an important distinction between separation. Our tools can have objectives, but their effects are often not entirely independent. The tools are complementary all the time. Notes that stably achieving maximum employment and price on a stable financial system. So because they're so intertwined, to me, there is not and a global financial crisis demonstrated financial stability, effect, stability, and we saw early at the outset of the pandemic. Extreme time each can be used for its intended Marsh weeks are tools, this window bank liquidity available, and that the ability of the financial system without restricting. While the financial stability tools help to calm conditions in the banking sector, developments there and our economic result or policy rate may not need to rise as much as it would have otherwise to achieve our goals. Of course, the extent of that is highly uncertain. So,
yeah, thank you. And of course, that I think the effectiveness of those tools is reflected in the fact that the FOMC has actually raised interest rates twice since the emergence of the banking strains. Of course, in that the purpose of that is to inflation. In fact, of the important and classic textbook distinction between supply shocks and demand shocks, and in particular challenges that a supply shock can present to a central bank. A lot of questions prior. We'll start with you. A number of folks argue
Barra is thought to have said, Ben, you're the baseball expert. You can deny us, but there of the vast increase in global labor supply, the development of efficient global supply chains, facilitated by technological advances and things like that. And I would say those positive supply shocks do not seem to be repeated. There are current inflationary surge of large negative supply goods and further shocks to supply chains. So we can't know what shocks will be or whether further negative supply shocks will come along. We'll be pandemic mercifully to memory. We can't really know that now. Is that central banks continue to be price stability, and that will require us to navigate more additional supply shocks. So as Tomas and Ben and their co-authors wrote in the inflation targeting book, what a central bank can do is control inflation. And that is true over time, even in the presence of supply shocks, should they come.
Ben, I'd love to hear your views on this.
So unusual events which disrupt economic functioning often are followed by inflation. Examples are World War I, World War II, the Korean War, and now the pandemic. And the pandemic just makes it harder for policymakers to understand what's happening and to react appropriately. And in particular, the pandemic scrambled the labor market, made it harder to judge the state of the labor market. The rise in commodity prices, which was difficult to deal with. We had supply chain issues, which was pretty much a new thing, which was also a contributor to inflation. So there are many features of the pandemic that made this an unusual episode and a difficult episode to address. That being said, I think that, and I've done some research on this with Olivier Blanchard that we're presenting next week, the basic mechanisms, I think, are still bad shocks. That's going to give you a problem, but the underlying mechanisms of supply shocks and tight labor markets and so on are really the same. I think it's going to change to gave us this episode going forward. I agree with Jay that we can't predict what new shocks will come. We've got new technologies out there that might make big changes in our economy. We've got green investment, things like that might affect the price and availability of fossil fuels, and so there are many things that we can't predict. But I think that broadly speaking, that the inflation process is not changed. At the Federal inflation expectations reasonably well. Always in inflation.
The role of the labor market tightness in the inflation process. On the eve of the pandemic, the unemployment rate was around 3.5%, a 5-decade low. Yet at the same time, inflation was kind of struggling up to 2% on a sustained basis. Here we are in 2023. The unemployment rate is roughly at the same level as it was prior to the pandemic, but of course inflation is far above 2%. So in that context, should we be thinking about the relationship between slack in the labor market and inflation differently? Do we not have the right measures of slack? Is it the problems with understanding what the natural rate of unemployment is? Or is that really, or is slack really not the key to understanding inflation? First.
I was talking about before, I think that the pandemic to some extent scrambled the usual signals from the labor market, and the Federal Reserve over time has begun to put more weight on ratio, which have a better period rate. So there has been scrambling. Those said, it's simply not true that even in people who understood since the 70s that there's not 70s, we didn't particularly have tight labor markets. Inflation, expectations not well anchored, strong tendency for price increases to feed into wage increases, to feed into price increases. So because of the presence of supply shocks and inflation expectations dynamics, there's no reason why low unemployment and high inflation can't coexist, but the remedies might be, depending on the situation, might be somewhat different.
Jay, how are you thinking about that?
So I'm very much in agreement with that. It's certainly true that we had both before and after the pandemic unemployment very low, close to 3.5%, but that we only had high inflation after the pandemic. Does that mean that our understanding of the relationship between slack and inflation is badly wrong, or that it has changed fundamentally after the pandemic? The questions. I think what resistant supply that feed the inflation process. I don't think labor market slack was a particularly important feature of inflation when it first spiked in 2021. I think that going forward, in particular, inflation, not services, showing signs of real persistent in diverse or high percent and the PC index. But all of this can be explained, I think, using our standard framework for understanding labor market slack. You could say it this way, that the now indicated a much tighter labor market in 2000. We began looking at much more measures, particularly vacancies, but also it's than the unemployment rate alone might have thought to in the 1% of cases. In 2008, the vacancies to market in labor markets, a steep flat.
To the topic of communications. Understood now that better the conduct of monetary policy, effective will be. But fostering that type of understanding really a lot of communications. And of course, that can be hard. Transparency and accountability. Ben, you've obviously played a critical role here, advancing the FOMC's communications, including preferences, FOMC, production of the summary of economic projections. So what changes over this period, revolution, would you highlight as being some of the most effective, most important, and where do some remaining challenges exist?
Well, let me talk about communication, because I understand it's I think that goes back to Alan Greenspan. You go back to 1994, the first of what's thinking and what it sees as the risks to the economy. But beyond that, you mentioned transparency and accountability, important to the Congress and to the public, and best way to do that is explain what we think, what we're doing, and that. There's the Fed puts issues that it's concerned about, economy, and respond to that. Or in the case of the think. Talking about, their own views and explain as do it, on the committee. In terms of I feel proud about the press conferences, which I introduce 4 times a year after the